If you look under the hood, it's fairly clear that things are deteriorating. The top line number looks great, but I don't pay too much attention to it anymore because my first reaction was, of course, the top line number, it looks good. We're coming into an election and the establishment wants to stay in the establishment. Remember, we had a big revision in these things down by over 800,000 several weeks ago. Now, all of a sudden, we get a surprise bump up. And my guess is this top line number will end up being revised down. If you believe Powell believes what he's saying, his interpretation was the job market's pretty robust. And the Fed does look at the job market. That's a very important thing. So if they think it's robust, maybe they won't go for a 50 basis point rate cut the next meeting in November. Maybe they'll go for 25. My interpretation is these numbers are not going to shove them to making unexpectedly large cuts in the federal funds rate or stopping, more importantly, quantitative tightening, which no one even talks about that. But quantitative tightening, shrinking the Fed's balance sheet, is still in place, still in gear. And by the way, that's why I said the money supply is lower now, the stock of money, than it was in July of 2022. But the rate of increase year over year in the money supply is still below Hanke's golden growth rate of 6% per year, which is a rate of growth in the money supply consistent with hitting the inflation target of 2%. So it's tight. Any way you cut it, it's tight. And the Fed should have dropped quantitative tightening a long time ago, in my view. You have to look at what's been going on with the money supply prior to it. The money supply has come down, and that'll be taking the pressure off of the labor market, not the other way around. And by the way, if you do look under the hood at the labor market and think it's deteriorating and getting soft, in general, in aggregate, they're probably taking pressure off of the labor market, not increasing. We see increases in wages with a lag after we've had a big jump up in the money supply. We've actually had a big contraction in the money supply, and with a lag, that tends to take pressure off. Former President Trump did say a lot of things. You got to be very careful with this. The category of jobs being increased were foreign-born. Now, foreign-born individuals aren't necessarily illegal. He defined them as illegal. If you look precisely at what Trump says, he uses a lot of adjectives that aren't accurate. But the general drift of what he had to say is correct. That is what the report says. But he tends to give it a little bit of an exaggerated flavor. He spins the thing the way he wants it spun. And a good example is the category for increased jobs was foreign-born individuals. And he labels those not as foreign-born. He relabels that category as illegals. Look at the dairy industry in the United States. Just for example, there are a lot of foreign-born, and I think probably, my guess is probably a lot of illegals too, in the dairy industry. So if for some reason you cut that out, what does it mean? Or you send them home. You send all the illegals in the dairy industry home. What does that mean? You have a labor shortage, and the wages for those people in the dairy industry go up, and you have labor problems. And ultimately, if that's the case, by the way, what you're going to find is that there'll be a lot of entrepreneurial activity and a lot of innovation in the dairy industry, and a lot more robots replacing human workers, laborers, and things like that. So it's all very complicated, and you have to be very careful with what one is saying and how you interpret. That's why I think you have to just look at each sector. You have different effects in different sectors on the labor market due to emigration or immigration, one of the two. Either going in or coming out affects different parts of the labor market in dramatically different ways. You have to ask, what are those government employees actually contributing? They're actually a drag on productivity. People wonder why productivity isn't booming, and that's because a lot of these people have jobs, and what are they doing? They're shuffling paper around. A lot of them aren't even going to the office. They stay home, and you know what they do. You got a bunch of couch potatoes getting a high pay. The government pay, by the way, is higher. This is another reason why you have more people going into government. You don't have to do much, and you actually get paid in the same kind of job activity more in the government sector than the private sector. So that's just the world upside down. I think the optimum size of the U.S. government, I agree with Milton Friedman, it's probably around 10% of GDP. The number is 35% now. I think it should be optimally about 10%. So that's a huge reduction, and that would be a huge benefit to the U.S. economy in terms of productivity and growth. The growth rate would go up and the productivity would go up. If you look at, for context, by the way, it's about 56% in France. It's 35% in the United States. It's about 56% in France. So you think things are bad here, go to France. Their growth rate this year is estimated at 0.7%, less than 1% rate of growth. They're in the tank. They got huge fiscal problems. They've just been downgraded by Moody's, even. Nothing but trouble. The stimulus package, it did turn around confidence, and the markets zoomed. Unprecedented rally in the markets. The markets had been going down, down, down in China. They just shot straight up. So there was a positive confidence shock, but it won't last because everything that you went through there didn't get into what's going on with the money supply. The money supply is growing about 6% per year in China, and Hanke's golden growth rate, a rate consistent with hitting the inflation target at 3% in China, is a little over 11%, almost 12%. So the money supply is growing way too slowly, and nothing in this package did anything to change the rate of growth in the money supply. So it won't be sustainable unless they goose the money supply. The money supply is growing at 6%. They've got to get it up to around 11 or 12% so that they can stabilize growth and hit their inflation target at 3%. Right now, inflation is essentially non-existent in China. It's 0.6% per year. So short term, it kind of a flash in the pan, a huge confidence shock. There's no question about it. The stock market's zoomed. Will this be sustainable? And to answer that question, you've got to look at what's going on with the money supply. And nothing they did has changed the trajectory of the money supply, which is very anemic. So flash in the pan, it's not going to last. If China increased the money supply and aggregate demand got up to a potential level where it should be in China, you'd see the big effect would be in the commodity markets because China is a huge importer of commodities. So China is basically the elephant in the room when it comes to the commodity markets. If China is doing well and growing rapidly, the commodity markets are strong. If China is not growing rapidly, then the commodity market's facing a headwind. Inflation is caused by changes in the money supply, and the great example of that is in the 1970s in Japan. What happened? There was an oil embargo in 1973. The Bank of Japan, and oil prices shot up with the embargo, of course, in 1973. And to accommodate that, the Bank of Japan loosened and goosed the money supply, and of course you had inflation. In 79, there was another oil shock. Prices of oil went up. The Bank of Japan says, we're not going to play ball with the thing this time around. We're not going to goose the money supply. And as a result, oil prices went up in 79, but inflation didn't go up in Japan because the money supply didn't go up. So inflation is always and everywhere a monetary phenomenon. Now, the big thing with the oil market and the geopolitical aspect is that Israel playing a dangerous game, and they're on the escalation ladder. And they're talking, even with the United States, and they've got one of the top U.S. generals is actually in Israel, and they're talking about striking directly Iran with an attack against oil and oil fields, oil refineries. Now, if you look at Iran produces 2% of the world's oil. So if the 2% was knocked out, and most of that's sold to China, if that was knocked out, it would have an effect on the oil market. That's what we're seeing right now. The key thing is the Strait of Hormuz. Iran could shut that down, and that accounts for about 20% of the world's oil production goes through the strait. because you got Saudi oil, Kuwait oil, UAE oil. It all goes through the strait. If that was shut down, you would have 20% of oil production shut down. So that's what's going on in the Middle East, a very dangerous game where the U.S. is unable to shut the Israeli war machine down. They're actually financing the war machine, and the bombs and things that they're throwing into Lebanon, most of those are made in the good old USA. The U.S. is playing kind of a double game here, and dangerous. You got two things going on. Oil production coming out of Iran, 2% of world's oil output. Oil coming out of the Strait of Hormuz, that's 20%. The Strait of Hormuz, that's 10 times more greater than the Iranian production. You would have a world depression if 20% of the oil was cut. If you shut the Gulf of Hormuz and there was other associated damage to oil production facilities in the Middle East, you'd really have a problem on your hands.